should equals to C into brackets. Just now I put the formula there up U minus 1 R into brackets 1 plus R T. Yeah, this is our new formula.
This 18.60, 1 plus 18.60.
This is one we completed. So we use this one to discount the capacity because this is the company's weighted average cost of capital. Okay, so use this one. Okay. So this one is annuity for 6 years, so you better use annuity. This is 12 million. This is 12 million. This is 12 million. This is what the rate. This one. Okay, so this is 0.1860. This is the same. 1860 is the same. 0.1860. This is year, so this is 6 increase. So when you do all these things, you multiply by this. You can use your calculator. You can use the calculator, or you can use the annuity formula. There's annuity formula, the one that I showed you. There's annuity formula. You can just put the figures in and you see you get the answer. You can get the annuity. The formula that I gave you this morning. The formula that I gave you this morning, the ZenWeb or any of them, you can just get the answer.
It comes for
Annuity, you go to annuity. You don't have annuity there, no. This one. You go to time value of money, yeah. Okay, and then you can see annuity, yeah, correct. Okay, so scroll down.
easy.
No, this is future value. You want present value. You want present, go up and say present value. No. You move too fast. Yeah. You see this present value of annuity, right? This present value of annuity. Yeah. So put in the payment. The payment is 12 million. 12 million. Yeah, the rate is how much? Yeah, you go to time value of money. Now we are dealing with time value of money. So go up. Okay, time value of money. Okay, go to present. Present value of annuity, right? Now, need that one. That is future value. What are you looking at? Future value. Of future value. This, yeah, that's correct. That's correct. But the same thing, but go up. This one. This one is future value. Where's your present value? Because we should
Yeah.
annuity. Yeah, we have to click on this one. Annuity. Your
It's very slow.
slow, right? Okay, so just look for the present value of annuity and put in the values. Yeah. So when you put in the values, how much do you get? 6 years? Yeah. And then how much do you get? The PV? Yeah, that's fine. Okay. So how much is that? 52. Ratio. I didn't get that. Your present value of annuity. Payment is
6.
yes, 6. No, that is correct.
12 payments?
Yeah, the payment is what? The payment is 12. That's 12 million.
Actual payment.
Yeah, but your rate is wrong. is what? 18.6. 18.6.
I see. Right.
Okay, then fine. Okay, correct. But 1.4. That's right. Which calculator? You got it? Yeah, that's correct. Put 1.33. That's correct.
How many?
Put 1.33. Yeah. Yeah. How much do you get?
Which tool is the video?
When you multiply, you get 43. Now you have to get 41.33 for this one. If you yeah.
Calculator?
Because this one is okay. 1 divided by 5. Okay, so 1 divided by all of this.
Savings, right?
Yeah. I guess you if no, you cannot use this. If you use this calculator, you cannot.
6 years.
So you better do the down and then do
The rate
do the down.
18.6, which is what we done there. The one that we got earlier. Yeah. Okay. Cost of capital, right? No, this is not fine.
Do you have can you install something on it?
Present value is 41 million.
Yeah. So I think you have to use this.
That's why let's develop this year.
We have to find like about the discount rate.
That one. That one.
The present value of this is only 41 million. This is saying that you need to save 12 million each year by doing it.
Yeah.
Although you have the investment, 50 million. Savings of 12 million. So 12 million, 6 years. I don't think we should have this, right?
But this one is double for company.
This is only 41. Yeah, 33.
You have to look for the one that you can use for our annuity. First I got
Then in this
4, 1, 3, 3.
Yeah.
Oh, this is an
Oh,
in the
yeah.
warehouse.
They got
This one there. That is really
okay, so you got answer 41.33, right?
41.
It's 133. 41.33. Yeah, that's correct. Yeah, that's correct. 41.
This is same IR and
No. This comes is this one.
suppose I write this one now.
Discount rate is okay, yes, okay, and then you put in the cash flows.
Yeah.
Yeah. You can get the same answer.
Yeah, I got this one same one.
Yeah.
In 5 years, you pay for that. Yeah. The value of that is only 41.
Yeah.
You can get the same answer. You can get the same answer. Yes. So please, if you do this one,
IR and
if you do this one, if you do this one, you get the MPV should be 15 million minus 41.33. Okay, so
Oh, okay. So that's one.
so this is million. Just put here million. It's okay. Everything should be in million. So the answer is how much? Minus 8.67, right? 7, yeah. 8.67. Okay? 8.67. If you do this, if you have time, you can do it one by one. You can get the same answer. But I think you use the annuity formula is much better. Okay? So use the annuity formula like this. This one, do it separately, and then do this one separately, and then you less and you multiply. And then you get this one. This is the cash, the initial initial investment. And this is the the present value of the future cash savings. The present value of the future cash savings. So this is the NPV. So what do you think? Okay, so you can decide. The decision rule. The decision rule is very simple. If NPV is negative, you reject the project. Okay.
In this case, it's not.
So you can the project. That's what I have has negative NPV using advance or the company's weighted average cost of capital. This means the financial market. The financial market this means that the financial market offers superior projects in the same risk plus okay. So what does it mean? The firm should reject the project. The firm should reject the project. So that should be your final answer. The firm should reject the project. This means that the financial market, because we calculate all these, the financial market offers superior projects in the same risk class. What risk class are we talking about? We are talking about the firm's risk class. Now let me say something here. We use the weighted average cost of capital when the company's or the business risk and the market risk are the same. Okay, if not the same, you cannot use the weighted average cost of capital. You have to look for a better discount rate. You have to look for a better discount rate. If the risk the company faces is not the same as the risk that within the market, then you have to look for a better discount rate. A discount rate, yeah.
When you're calculating the NPV, if it's minus 50 million minus 41.23, isn't that minus 91?
Which one is minus?
NPV minus equals to minus 91.
Oh, this is positive.
Oh,
sorry.
Okay.
This sign just shows outflow, the initial investment. That's the meaning. We don't have what minus money or currency in the world. It just shows this sign repeated. Yeah, okay. There to show initial outflow, initial cash outflow. Is that okay? So that is how you can evaluate an investment to see whether the investment is worth the company's money or not. Number two. Now look at number two. Number two is very straightforward. Furniture Depot Incorporated is an all equity. You see, it's an all equity firm with a beta of 0.95. The market risk premium is 9%, and the risk-free rate is 5%. The company must decide whether or not to undertake the project that requires an immediate investment of $1.2 million and will generate annual after-tax cash flows of $340,000 at year end for 5 years. If the project has the same risk as the firm as a whole, should Furniture Depot undertake the project? Okay, so you are supposed to advise the company as to whether the company should undertake the project or not. They are giving you the company's equity situation. It's an all equity firm. That means there is no debt in the company's cost structure. Is that okay? It's an all equity firm. So what we are saying here is that if you calculate for the cost of equity, that is the cost of capital. From the beginning, I said it, right?
It's 100%.
Yeah, this is what is 100% equity finance company. 100% equity finance company. So can you do that? The first thing is to determine the equity, the cost of equity, using the SFL formula. Using the SFL formula. Yeah, the cost of equity equals to risk-free plus beta of equity times the market risk premium. That's it. If you use the SFL, that is security market line formula. So the cost of equity equals to risk-free plus beta of equity times the market risk premium, so that you can get the cost of equity, which is also the cost of capital. So you use this one to evaluate the investment that the company wants to make. The company wants to invest in a project. The company wants to invest in a project. The project cost is $1.2 million, and the annual after tax cash flows, the cash inflows will be $340,000 at year end for 5 years. So advise the company whether the company should undertake the project or not. You have to use this one, this formula, SML formula. You cannot use the dividend growth model. Because they give you, the question gives you, is it this the beta, and this the market risk premium, and the free. So you just use the what? It's free 5% times this one, you get the answer. So yeah, let me see. Okay, let me see. Yeah, correct. That's correct. 13.55. Correct. 13.55. So you use the 13.55 to do the investment valuation. Yeah, we get 1.2 million as the initial cash outflow, and then the cash inflows are The 5 years cash inflows are 340,000 at the year end.
It's 1.5.
Yeah. That is 0.13.
So
So it's like 1.5.
the NPV is how much?
1.5.
No. How much do you get for the PV? The present value for the future cash inflows. The future cash inflows 340,000 for 5 years. So you can just use the annuity. Use annuity.
170 million.
Yeah, 1179983.48. Yeah, correct.
1 what?
1179.
Yeah, 79983.48. Yeah. So that means you have 1,179,983.48, and then the outflow is 1.2 million.
So it's coming -200.
Yeah, 20016.52, which is negative.
We don't take the.
Yes, because the net the NPV is negative. So since the NPV is negative, the company should reject. The company should reject the proposal or the investment. Is that
What's the
okay?
discount rate?
Huh?
What is the discount rate just now?
Oh, the discount rate we have already calculated. That is 13.55%.
What's that?
Yeah, 13.55. Yeah. 13.55. Okay.
How much is it?
And
Minus.
Mike, what's up?
Yeah.
Is that okay? Not okay. That's good for you. And is it okay for you? Okay, my hand. Not okay.
340,000.
Then I lie.
5 years. And the rate is 0.5.
You see, it should be like this. The first thing you have to do is use this formula. The figures are given to you. This is what, 5%? It's 5%. It's 3. Beta is this, so this beta. And the market for what rate is this. That's it. So you just multiply this, plus this. Do this one to discount the cash flows that will come in, right? This is the initial outflow. Okay? And then the company will get 340,000 every year. 330,000. The investment will generate at year end for 5 years. So this for 5 years, you discount this one after 5 years. So you use annuity. You use the annuity formula, right? The annuity formula that you use and then you get this amount. This is the initial outflow, 1.2 million. The present value, 1 point something, right? So you make a loss. So the NPV is negative. The firm should not undertake the project.
That's because I need to put the degree.
Oh, you did not? You did not?
Okay, please.
Yeah, of course.
I can see you guys are enjoying Christmas here.
So how much you get?
Rich, is that okay?
0.02.
Okay.
Negative.
Yeah, this one. Yeah, right. So you use this one to add the discount rate. NPV. Yeah, the initial outflow is 1.2 million.
1.2.
Yeah, 1.2 million.
See,
Plus, yeah, the flows will be 340,000 for 5 years.
look at the other one.
You have to discount it. You see, you cannot do it. If you do it this way, you cannot get it. So you have to discount it like this.
I hope this number is right.
Discount. Yeah, and this is 340,000. That's best year, right? Yeah. So you do it up to year 5. You have to year 5. So it's better you use the annuity. Otherwise, you have to do it one by one. Up to 5 years. Long. But you can use your calculator and use the annuity. You have the formula?
It's on that website.
Yeah. Just go to the website that I showed you this morning. Let's go to Zenworth. Yeah. Okay. And then you go to table of money. Yeah, okay. So go to annuity. Yeah. Okay, so yeah. Okay, present value annuity. Yeah. Yeah. Okay. So put in the information.
So payment 1.2.
Yeah. No. That is that. You are only doing this one. You have to keep it. You are doing for the 5 years cash inflow. 340,000. Check the zeros. Okay. The rate is what? 30.55. Okay, yes, 5, and then just calculate this. So you get this one. That's correct.
Oh, okay.
This minus 1.2 million plus this, so you have effect 2 million.
All right, that's 22 million.
Okay, any question, please?
What's the answer?
How much is the value?
Minus 20. This shouldn't be 20 million. Yeah, because you are not looking at the yeah.
Okay, 6 again.
Okay, please, any question? Any question, please? If you don't understand, don't worry. When you go home, don't eat. Yes, if you go home, don't eat. So I think if you, unfortunately, I don't have the answer what the answers for you, because I expect you to be able to work this out by yourself. Right? The important thing is the understanding. And from what we are doing, I think it's okay. I believe once you go back and you take your time, you go through, you get everything because you understand the concept. So you just go back home and take your time and go through. Now, if no questions, let's move on. We have 54 slides to go through before we do this. 54 slides. It's a long marathon. So are you ready? You can take coffee, water, hot or cold water. They have everything you want. They will give it to you. You just tell them that I say they give everything you want, except human blood. Okay. So let's see. Let's look at this one. Yeah. Okay, let's look at NPV. We have been using the NPV, right? So let's go a little bit detail about the NPV and investment evaluation, how companies should invest. NPV and other investment criteria. So Yeah, so we're looking at NPV, which I know you guys know. Then other investment criteria like payback value, the payback period, internal rate of return, average what do you call it? Returns, and then accounting rate of returns. But we will be concentrating on the NPV and payback period, and then the internal rate of return. And then we try to look at mutually exclusive projects, exclusive projects, and what it means when we say project is mutually exclusive, and then how to select or choose between mutually exclusive projects. What are the selection criteria that the company or the finance manager must use to choose? And the last part of our study will be looking at what we call capital rationing. Capital rationing. Capital rationing. I hope you understand capital rationing. When we say capital is rationed, I hope you understand. That is when an aggressive and enthusiastic, maybe a divisional manager is given a hot by the superiors when they find out that the guy is so ambitious that he always has ambitious projects to offer or to suggest. So they give him a cap that, hey, Eric, we know you have a lot of good things to offer this company. We can't do everything. So this is the limit. When a company sets a cap, how much investment can be spent? Okay, when there's a limit, that is when we talk about capital rationing. Capital rationing. You cannot spend beyond the cap that has been given to you. Okay, so where companies have many projects that they believe that they can all add value to the existing value of the company shareholders, but then the company cannot afford to take all the projects. So what should they do? Looking out at all the projects, looking at the cash flows, the present values of all the cash flows, or the NPVs of all the cash flows. The company can or should undertake all of them. The company should undertake all of them, but then the company has limited capacity in terms of the capital. So we use the capital rationing to make the choice. And in this way, the technique or the method that is used is what we call the profitability index. Is that okay? So when we talk about capital rationing, the technique we use in making a choice of the project that one can undertake is profitability index. So we shall use that will be the last thing that we look at. Okay, so let's get going. Yeah, so the NPV, that is the present value of cash flows minus the initial investment. That's it. I hope this one everybody understands. And as I said earlier on, we have what we call opportunity cost of capital. If you don't invest your money here, you lose. If you invest your money here, you lose the opportunity to invest the money in equally risky projects. So this is the expected return that those investing in projects expect. So expected rate of return given up investing in a project. Expected rate of return given up by investing in other projects. That's the opportunity cost of capital. Sometimes we call it cost of capital. It is Now let's look at a very simple situation. Let me do it this way. Now, suppose we can invest $50 today and receive $60 later today. What is our increase in value? The increase in value is how much? $10, right? Very good. That is true. That's $10. Very easy. So, oh, I made a profit. I invested this morning. Those who love to stake lottery. Okay, so it's just in the morning, early in the morning, when the kids are looking for money, say no, I don't have money. Just stake lottery, and that is the evening you get what 10 as an added value. Okay, so as an added value. It's very simple. Okay, so let's look at it. Suppose we can invest 50 today and receive $60 in 1 year. You see, we are changing the situation now. We are getting into a real situation. In 1 year, what is our increase in value given a 10% expected return? Okay. So what will be the added value? What is our increase in value given a 10% expected return? Yes, who can tell me? It's very simple, right? We invest this one today, and then we expect to get 10% in return. So what will be the added value?
10% of 60.
10% of
$60.
So how much? 6. Who agree with 6? I don't know. Patrick, what do you think?
I think so. It's 6.
You think?
10% of 50.
You think it's 10% of 50, right? It's good to think. If you don't think, what do you say?
If I don't think, I can't say anything.
Oh, you can say something.
15.
15. Patrick, you didn't think, right? You said 15.
No. So I invest 15. I get 16 in 1 year.
Yes, I like it. Now, look at this. Okay, we are bringing in
5.
5.
Yeah.
Okay. We are bringing in what?
50 years.
What situation are we finding ourselves? We are finding ourselves in what? We are taking into consideration what?
It's supposed to be 55, but he got 60. So
Plus 10%.
so it should be 5 then, because he got 60.
Yeah.
He got more than what he expected. He invests 50.
Yeah.
So in 1 year he's supposed to get 10% return. So it's supposed to be 55. But instead of 55 he got 60. So 60 minus 55 is 5.
Okay. Good. Let's see. I don't know.
Huh? Okay.
Do you accept the results or not? Your money has reduced, right? No, you see, you forgot about time value of money.
Okay.
You forgot about time value of money. Expected return is 10%. That means you have to discount the value. Okay? The $60 is a future cash inflow, right? And we expect it in a year. And we are expecting the return that we expect. That is, if we invest $50 and we expect to have a 10% return in 1 year, which is $60. Okay, the added value is how much? So you have to discount the $60 to today. All right. So this is the initial the initial investment that you give to the bank. Okay, and then this is the expected future cash inflow. So if you want to bring this amount to today's value, all right, you have to discount it by the expected return. 1 year, just up to here by 1. Only that we are not seeing the 1. So you discount this one, you get how much? You discount this one, you get how much? 40. 45. Cannot be 45, just like that. Because you can see here.
Minus 4.5.
Yes, great.
54.55.
54.55. Very good. Okay, so it means that you see what we are trying to say here is that if you want to earn a value of this, okay, if you want to earn a value of this amount of this next year, you have to invest. You have to invest how much? Oh, 50. No. 54.54. Oh. Now, what is the present value of this one? What is the present value of this one?
54.55.
When you go to the bank and they delay you, you think they are playing hard on you, right? Okay, now this is what starting from what next year.
Yeah.
So if you want the PV, the present value for today, you divide this one, you discount it by this one by 1, only 1 year. So what is the answer?
4.55.
54.55.
0.55.
Okay, 54.55. Okay. So what it means is that now what we are saying is that if you want to earn $60 next year at the rate of this 10%, you have to invest with the bank or have to put your money 54.55 today. So next year you can earn this one. You can check. You can check it out. Why don't you multiply this one by this one and see whether you get this one or not? You get it, right? So that is the meaning of what we are saying. Okay. So if today you are investing 50, all right, and you are investing 50, okay, and the value of the money that you are expected to receive in a year's time, the value is this today. The value is this today. That means that you are making the added value to your money will be 4.55. You know it today before you invest. That's what we are saying. Is that okay? This is the value. This is the value the value today of this. Sorry, please.
Right now you are investing, so we are thinking about future. How much after 1 year?
Please, is that okay? Do you agree? Do you understand? So if you want to earn this, today, next year you have to invest this. That's the meaning. And if you are not investing this, okay, but you are investing this, that means and if you get this, that means your added value is this. Is that okay? Good. Let's move on. Whether you understand or not, we still have to move on, right? Whether you understand or not. And for me, I think it's good not to understand, you know. So the NPV, this is the formula. NPV equals to the PV of the cash flows minus the initial investment. This is the formula. Okay. Since you understand, move on with the details.
That is for multiple, yeah?
Yeah, cash inflows, yeah. Into the foreseeable future. This is the initial outflow. Please, anytime you see the C0, that is the initial cash outflow. And these are the inflows, the respective inflows. So these are the technologies. Really quick, right? The cash flows, time, period of the investment, and then R is the opportunity cost of capital. The cash flow will be positive or negative at any time period. Let me say this. In investment valuation, if you are evaluating investments, don't expect the cash flows to be positive all the time. There will be negative cash flows. The results will still be the same, not have any impact. Because sometimes a company may make losses. It will not be always gains. Okay, so you have to keep in mind the cash flows will be positive or negative at any time period. So here, that's what we said last week. Managers increase shareholders' worth by accepting all projects. Accepting this is the NPV decision rule. Managers increase shareholders' worth by accepting all projects that are worth more than they cost. So if you are asked, how can a manager increase the shareholders' worth? This is the answer. As by accepting projects that are worth more than the costs. Okay. Therefore, they should accept all projects with a positive NPV. Okay, I have this. Actually, I have it. I have it in the questions for you. But let's go through all the situation before we come to that. So let's look at some of the decision criteria. Let's look at some of the decision criteria. These are the decision criteria tests for NPV. Does the NPV rule account for the time value of money? What do you think? The answer is yes. Does the NPV rule account for the risk of the cash flows? Yes. Does the NPV rule provide an indication about the increase in value? Yes, because that's what we saw, right? We saw that you can actually see how much value you're going to add if you invest this amount of money for 1 year. Okay. Should we consider the NPV rule for our primary decision rule? Yes. The answer is yes. We shall actually see it later on. It is the ultimate decision rule. It is the ultimate. Okay. Now, the risk that we are talking about, the risk of the cash flows is accounted for through the choice of the discount rate. Through the choice of the discount rate. What do we mean by this? What we mean is that depending on the risk that shareholders or investors think that they are exposed to due to the nature of the business. They ask for risk premium, or they ask for higher returns. Okay, so the returns, the higher returns that they ask for, takes care of the risk because of the risk of losing their money. So they increase instead of maybe say 25% return percentage, they will tell you that okay, I expect you to give me 50%. So the 5% is a premium. So that's what we mean by the risk of the cash flows is accounted for through the choice of the discount rate. And then this is the payback period. Payback period. Payback period. The payback period. The payback period, time until cash flows recover the initial investment of the project. The payback method is also another way of evaluating what investment projects. But we will find out whether it is indeed a reliable tool or not. Okay, there are so many tools that we can use to evaluate investment in projects. How long will it take? Because like from my personal experience, from the month of October, November, I had a series of I had conference call with some investors in the US, and the moment you talk to them, the first thing they ask you is, last week we said it, right? How much do you want? Why do you need the money for? When am I going to get back my money? See, when am I going to get back my money? Before they talk to you about all the details and whether they are going to say yes or not. Okay, so the payback is very, very important to most investors. All right. The payback rules specify that a project be accepted if its payback period is less than the specified cut-off period. So at all times, in the company's policy, you will see the cut-off period. So if the payback is less than the cut-off period, that project should be accepted. Is that okay? So let's look at there's an example that shows that this statement is absurd. Okay, if the project gives you a payback period less than the cutoff, you have to accept it. Why do you think you have a problem with it?
It doesn't talk about future risk.
It doesn't take into consideration the time value of money. Okay, very good. What else? What do you think?
Number 2 is the cash inflow is not equivalent to the cutoff. It's very difficult to determine the cash inflow, each cash inflow with the cutoff period.
It's difficult.
Yeah, it's difficult.
How difficult? What do you mean by difficult?
For example, I have 100 million.
Yeah.
100 million cash outflow.
Mm.
So first year I get like 600,000. And 300 consecutively. So sometimes it may exceed the cash outflow with the cash inflow. So maybe cutoff point should be some point.
Yeah, but still you can decide, right? What he's saying is that sometimes when you do the accumulation to find out when the inflows will cover the initial outflow, it will be more than the accumulation. The accumulated amount will be more than the initial outflow, the cash outflow. But then you take that portion, we shall look at it, you take that portion, it's just a percentage. You don't need to take all. Because you just want to know when can I make up the initial investment with these cash inflows? How many years would it take me to cover or to break even? Is it to break even?
And it doesn't consider the interest rate.
Yeah, of course. It doesn't consider interest, but you see something here. Look at this statement. I asked the question because of this statement here. The payback rule specifies that a project be accepted if its payback period is less than the specified cut-off period. What about, there are some projects that the cash inflow that they generate takes some time. You see, takes some time to come in. So suppose that the project, we shall look at example very soon. Suppose that the project takes time to generate cash inflows. Okay, say this year we spent $200,000. Next year, maybe we cannot get anything. But the second year, third year, our project will start generating more money. All right. So if, for example, this year, next year we are not able to get anything, so it's zero. But second year we are able to cover $200,000. That is the cutoff. But what about the third year? If the third year cash flow is say 300,000, going at 400,000, according to what payback method, we should ignore those inflows, cash inflows after the cut-off period. That is not good for investment, because the idea is that the company or the business must continue into the foreseeable future. So if you are only looking at the first year or some few years cash inflows to determine the viability of the project, that may be misleading. All right. So let's look at this. Let's look at this and see what we are trying to say here. The three projects below are available. The company accepts all projects with a 2-year or less payback period. Show how this decision will impact our decision. That the decision of accepting project with a 2 years or less payback period. How will this decision, how will this policy affect our decision as to whether to accept the project or not? Which of them? Project A, the initial cash outflow is 2,000. In the first year, it was generated $1,000. Second year, $1,000. Third year, $1,000. Project B, initial outflow $2,000. The first year $1,000 inflow, second year $1,000 inflow, and then the third year no cash inflow. Project C, initial outflow is what? $2,000. Year 1 inflow is 0. Year 2 is 2,000. Year 3 0. Now, what is the payback period for all these other three projects? 2
years.
Yes, because for this is 1, 2. Okay, so the payback period for project A is 2, and then this one 1, 2, so also 2, and then this one 0, 2. What can I do with 2? Okay, so that is 2. So we have to accept all the project, right? According to the payback method, 2 years or less. So we have to accept all the method. This one. So let's look at the absurdity about this decision, or the payback rule, as we are saying. Given NPV of 10%, what is the NPV value here? Yeah, can you check the NPVs? Just this 1, 2, 3. Just get this one. 1, 2, 3. It means you discount this one by 10%, discount by 10%, discount by 10%. Okay, this is discount by 10% to the power 1, discount by 10% to the power 2, 10% to the power 3, and then you get the PV, the present value, and then this is the net, the outflow. So you find the net, you put it here. This one only 2, so we find it here. This one you discount by what? 10% up to 2 years. All right. So when you do that, so these are 2 years, and let's look at this. Look at this. Let's look at this. Look at this. Look at this. This is the NPV for project A. The initial outflow $2,000. Year 1 inflow is 1,000. Year 2 inflow is 1,000. Year 3 inflow is 10,000. You understand? 10,000. Now, according to NPV of discount rate of 10%, look at the net present value, 7,249. Now, look at this one. The NPV is negative. The NPV is negative. So, should we accept all the projects? We cannot accept all the projects if we are using the NPV. But according to the payback period, which even ignores the cash flows beyond the cut-off period, ignores, cannot. And look at this. These project A, B, and C gives a negative or cash or NPV. That means they do not add value. That's the meaning. The point is that they do not add value, but this payback period cannot point out. The payback period cannot point out that these projects do not actually add value. The project do not add value, they will rather take away the value, and that is the danger that you don't want to do. Okay. As you remember, last week we used the Chicago Tribune as an example. Wrong financial decision cost the company a lot of money. The company had to file for bankruptcy. Okay, so if you are making a decision based on the payback, you find yourself investing in a project that will destroy your finance. Okay. So that is why we are saying that this decision of the payback is upset. Okay, any question? Any question, please? So these are the decision criteria tests for the payback. Does the payback rule account for the time value of money? No. I don't understand why. I put all the responses here, but I cannot see them, you know. I don't understand why. Does the payback rule account for the risk of the cash flows? No. Does the payback rule provide an indication about the increase in value? No, it doesn't. Should we consider the payback rule for our primary decision rule? Obviously, no. Okay. So this ones, maybe you can read these things by yourself. Not really. You can read if you want to enjoy payback period. If you want to use it for your business, you can read the advantages. And we have another part that we call the discounted payback period. Discounted payback period is just discounting. Just use the cost of the given cost of expected return just to do the discounting, like the normal discounting that we do. Okay. Compute the present value of each cash flow, and then determine how long it takes to pay back. That's it. Instead of the normal normal cash flows that we add, we will discount them. We will discount them, find the present values before we just add them. Okay. So the decision rule: accept the project if it pays back on a discounted basis within the specified time. So the criteria test for the payback. Does the discounted payback rule account for the time value of money? Yes, because we discount it. Does the discounted payback rule account for risk of the cash flows? Yes. Does the discounted payback rule provide an indication about the increase in value? No. Should we consider? No, we cannot consider it as the main, the primary decision rule. Okay, these are the advantages. Okay, so let's look at the next important thing, that is the internal rate of return. Internal rate of return. Discount rate at which the NPV equals to 0. That's what I put this one here. Okay. Invest in any project offering a rate of return that is higher than the opportunity cost of capital. That is the rule for the internal rate of return. Rate of return, that is, say the first year cash inflows minus the investment divided by the investment. If you want to get, this is just what do we call it, in percentage. If you want to find the very simple percentage, this is almost the same. You do this, you can equate this one, and then this one, this one, this one. You can bring this one here, or yeah, and then you equate this one. You can see everything will become 0. You just put everything here, everything becomes 0. It's like the same thing like this one. Okay, but in a nutshell, what we are saying is that the internal rate of return is a discount rate at which the LTV is almost 0. It's almost 0. Now, in the past, we used to use what we call interpolation, try and error, to calculate the internal rate of return. But this time, we use the financial calculator. It's much easier, make it easier. So we are saying that is the most important alternative. What IRR is the most important alternative to the NPV. It is often used in practice, and it is intuitively appealing. Why we use the word intuitively? Intuitively because people prefer to express returns in percentage than in dollars, especially when they don't have the whole information about the company. But it's easy to explain to people that, oh, okay, if you invest, you get this return. They prefer to have it. So most people use the internal rate of return in business discussions, because people feel that instead of going through all the information and the figures here and there to get the net present value, NPV, to decide whether the investment is worth undertaking or not. So they prefer to use the internal rate of return to talk about business discussions. All right. It is based entirely on the estimated cash flows and is independent of interest rates found elsewhere. So this is the formula. I just repeated the formula. So what we are saying here is that the internal rate of return rule is very important. Management and individuals in general often have a much better feel for percentage return. That's what I was just saying. And the value that is created than they do for dollar increases. A dollar increase doesn't appear to provide as much information if we don't know what the initial expenditure was. Whether or not the additional information is relevant is another issue. We shall see which one is the best decision tool to use. Decision tool. So the decision rule for internal rate of return. Accept the project if the internal rate of return is greater than the required return. That is, if the internal rate of return is greater than the opportunity cost of capital. You accept projects if the return is higher than the cost. Okay, that's the meaning. Computing internal rate for a project. If you do not have financial calculator, go and buy one. That's the meaning. Otherwise, you sleep. You spend your whole life. You can never get the answer. You know. You have to be doing what interpolation, choosing figures that is minus. No, normally the strategy we use is if you want to do it manually. So if say the NPV is, if the NPV is say 20, okay, so you multiply by say 3. and you negate it, the internal rate of return. You see, so if you do it like that, then you see that you negate it 3 times, the NPV value by 3 times, and you make it negative. So you will see that when you calculate, it will be almost 0. Then you just take it like that. Just take it and use approximation. It should be okay. But today we have calculator, so it's not difficult to do. Decision rule. Does the IRR rule account for time value of money? Yes. Does the IRR rule account for the risk of cash flow? Yes. Everything is yes. But the last one is yes and no. Should we consider the internal rate of return rule for our primary decision criteria? I said yes, and I said no. Why I said yes? Yes, because many people feel it's easy to explain. All right. Now you can use it. You can use it if you are certain about the entire information. You can use it. No, because there's a problem that the NPV doesn't have. When you are evaluating projects that comes with what we call it non-conventional, non-conventional cash flows. What internal rate of return, the IRR has a problem with it. When we say non-conventional cash flow, that means the cash flows are not even. You have 1 million, you have 900,000, you have 700, 500, and then the internal rate of return starts shaking. Cannot take it. Is that okay? That's what we are saying. It cannot take information. It will give you different answers. If the cash flows are not even, it gives different different rates. So the question is, which of them would you use to make your decision? Okay. Yeah, when I'm talking about the internal rate of return, when the cash flows are not the same, are not even, it gives different rate of return. So the question is that which of them would you use to make your decision? So it cannot be used when you cannot rely on the internal rate of return when the cash flows are not even. You cannot. But NPV doesn't have any problem with that. Internal rate of return is also, from my understanding, is more of approximation. But using NPV, you are dealing with the cash flow, the free cash flow. All right, which makes your calculation or your measurement close to reality, and that is excellent measurement than the internal rate of return. Okay, so that's the meaning of yes and no here. Any question, please? Okay. So this is the decision criteria test. Okay. So this one I've already explained. So we move on. Advantages, you don't need to have the advantages. If you want to know, you go and read. You can find it, you just Google advantages of internal rate of return, but you don't need it for anything. If you know it, it's good, but nobody will clap his or her hand for you. You know, okay? So let's move on. Let's move on. We have a lot of things to do. Word of caution. So this one I think is better. It should be noted, however, that if you get a very large, you can use the NPV, but if you get a very large internal rate of return, that you should go back and look at your cash flows estimation again. In a competitive market, extremely high internal rate of return should be rare. Also, since the internal rate of return calculation assumes that you can reinvest future cash flows at the internal rate of return, a high IRR may be unrealistic. Okay, so when you get a high rate of return, then you have to check your cash flows figures. So let's look at this. Let's wait. Don't worry about it. We will look at. I have the questions there. Look at all the questions there. So, so this is what I said initially. calculating the internal rate of return can be laborious task. Fortunately, financial calculators can perform this function easily. Okay, so it's better you learn how to use your financial calculators. And this is just how to use it when you want to use the calculators. Different calculators, different keys. Okay, this is what I want us to look at. This is very important. NPV and IRR will generally give us the same decision. Exceptions. I have explained this one. Non-conventional cash flows. That's cash flow signs change more than once. Okay, it's just not the same, not even. Mutually exclusive projects. When you are dealing with mutually exclusive projects, internal rate of return has a problem there. Okay, we shall look at it very soon. Initial investments are substantially different, and then the timing of cash flows is substantially different. Okay. So these are the non-cash flows issue that I was talking about. All right, so now some people believe that. Okay, let's continue. I think it's better we continue. Let's look at this one. Now, suppose an investment will cost $90,000 initially and will generate the following cash flows. 1, 2, 3. 1, 2, 3. You see, this is minus 150,000, please. The required rate of return is this. Should we accept or reject the project? What do you think? If a project has this, should we accept or reject? If a project, the initial investment is 90,000 and the cash flows 132,000, 100,000, 150,000, and then the expected return is this, should we accept the project or reject the project? You have to calculate, you have to determine the NPV for the project before you can see anything. Let's check together. This is just an example. Now, here we are. Okay. This is if you use if you calculate by yourself, you can do it this way. If you use calculator, this one, the calculator. If you want to use the calculator, this is the initial outflow. So you put minus. Okay, you put minus, and then the cash flows for the first year, this one, and then second year, third year, that's it. And then the interest, and then you calculate, you get this. The same way, if this is the first year outward inflow, then you discount it 15%. Second year, discount it, raise to the power 2, and then this one is minus 150,000. You discount it and then minus the initial outflow, so you get the net NPV like this. It's the same. If you use the calculator, you can get. If you use the calculator, the time what value of money. If you could use that time value of money, you should be able to get 1,700 and this. Now the question is that should we accept or reject the project? Should we accept or reject the investment? What do you think from this? We should accept, right? Because the NPV of the project or the NPV of the investment, is positive. Yeah, so we should accept. So let's see what happens. Now, let's look at something. If you calculate the internal rate of return, if you compute the internal rate of return on the calculator, you get 10.11%. Okay, you get 10.11%. So with internal rate of return, you will reject the project because the expected return is 15. Right? The expected return is 15. The cost of the cost of capital that you use is 15, and then the return is 10%. So you reject the project. But then the NPV is positive. So what do you do? You see, that's what I'm trying to say. What do you do? NPV versus IRR. You must always go with the NPV. NPV is the ultimate investment decision tool. So you have to go by the NPV. Now, if your NPV is positive, it means that the investment will add value. The investment will add value for that amount. Okay, and what it also means is that any return rate between 10.11% to 15% should be accepted. That is the meaning. Any return rate between 10.11 and 15% should be accepted. All those rates will add value to the investment. But if you want to decide whether you want to invest in the project based on the IRR, you reject the project because the IRR, which is 10.11%, is less than the expected return on the project. The investment decision should be based on the value of the NPV. That is what I'm saying. Any question, please? Any question? So this is what I just said. Okay, this is what I just said. Any rate between here, any rate you have to accept. Now, I deleted one or two slides from it. If you do the calculation, you realize that the internal rate of return gives you two values. The internal rate of return give two values because you saw the cash inflows, right? 100,000, 132,000, 100,000, and minus 150,000. So the internal rate of return will give you more than two rates. See this one and this one. So you get confused as to which one to base your decision on. That is not good enough if you depend on the internal rate of return. So you go with the NPV. Go with the NPV. Any rate here should be okay. Any rate should be okay. Okay, so summary of the decision rules. The NPV is positive at if you do the NPV, that is the NPV is positive at a required rate of return. That is just now with the one that we just calculated, 1,000 something. The required rate of return is what? 15%. So you should accept the project. If you use the financial calculator, you will get an internal rate of return which is 10.11% or 10.11%, which will tell you to reject, but you cannot do that. You need to recognize that there are non-conventional cash flows and look at the NPV profile. That's the one that you just saw. I told you already. Okay. So when you have NPV and internal rate of return conflicting, you must always go with the NPV. Now, mutually internal rate of return and mutually exclusive projects. What is mutually exclusive project? If we say projects are mutually exclusive, it means that if you choose one, you cannot choose the other. That means they are mutually exclusive. If you undertake project A, if project A and project B are mutually exclusive, If you undertake project A, you cannot undertake project B. If you undertake project B, you cannot undertake project A. They are mutually exclusive. Mutually exclusive projects. If you choose one, you can't choose the other. Example, you can't choose to attend graduate school at either Harvard or Stanford, but not both. You choose one. Intuitively, you would use the following decision rules. NPV, choose the project with a higher NPV, and internal rate of return, choose the project with a higher internal rate of return. Okay, so here we are. We have two projects. You have two proposals to choose between. The initial proposal H has a cash flow that is different than the revised proposal. The revised proposal is R. Using internal rate of return, which do you prefer? Okay, so the initial proposal is this. The cash outflow is this, the inflows are this. And then you are supposed to calculate this one. So you get this. And then this one is only this one. One outflow, one inflow. And then you get this. So which of the project would you prefer? If you look at the internal rate of return, which of the project would you prefer? The first project H or project I?
Right.
You go for project I, right? Because it has the highest the highest internal rate of return. It has the higher internal rate of return. Now, these are mutually exclusive projects. So when you undertake one, you cannot undertake the other. Okay, so if you choose this one, you cannot choose this one. If you choose this one, you cannot choose this one. So obviously, we will choose the one that gives us the higher internal rate of return, right? Yeah. These are H and I are mutually exclusive projects. Mutually exclusive projects. Now let's look at something here. The same project. You have two proposals to choose between. The initial proposal has blah 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 blah. This is what we are doing in the same project. Using internal rate of return, which do you prefer? Now, let's look at it when everything is complete somehow. So the initial proposal, and then the revised one, the I. This is H and I. This is what only one. The inflow is the outflow is 350. The inflow is this, and then and then this is outflow 350, and then the inflows are 1, 2, 3. Okay, so this is 14.29%. This is 12.96%. But if the project has cost of capital or opportunity cost of capital of 7%, you can see the NPV. The initial proposal, the NPV is 24,000, and then the revised one is 59,000. Now, these are mutually exclusive projects. If you choose one, you cannot do the other. Before we said I will choose this one because it has the highest NPV, highest internal rate of return. Okay, but now if you look at if all the information are provided for you, you realize that choosing the first one is not good. Even though the NPV is positive, it is more worth your money to invest in the one with the highest NPV. Okay. So what we are saying is that when it comes to mutually exclusive projects, internal rate of return can give conflicting decision results. Stick to the NPV. That's what we are saying. Can we have a short break, please? Have a short break. The room is too quiet. The weather is too calm. The environment is very calm. If I don't take care, some people